Today, we are diving deep into a very volatile, very interesting financial analysis report that's focused squarely on Tilray. That's ticker TLRY.
That's right. And the immediate headline, for anyone just glancing at this, is pure panic. On December 26th, Tilray flushed another 5%. It just sliced right through that psychological $10 arc and landed at $9.60. For a lot of people, that move, it just screams failure.
Right. But the analysis report we've synthesized, it suggests something else, that this initial fear might actually be masking a really profound long-term opportunity. So our mission today is clear. We need to test the report's central thesis. Are the bears right? Is this thing going to keep dropping, or is this $9.60 price point, and I'm quoting here, the gift of the year, a potential ultimate entry point for someone who's focused on that 2026 horizon?
And that's what we're going to do. We're pulling the key insights directly from the source material. We're going to unpack the specific drivers behind this recent crash. Yeah. We'll detail the company's internal safety net and lay out two major catalysts that are expected, very, very soon. Yeah. It's all about separating that short-term noise from the long-term signal for you.
Okay, let's unpack this. The stock is down, and, logically, when prices drop like that, the market assumes something fundamentally broke. But our analysis, it's suggesting this is more of a psychological crash, a technical one. So if we look at the source material, what specific short-term factors created this huge selling pressure, what the report calls the bear trap?
Yeah, so the analysis points to two distinct pressure points. And this is really the crucial part. Both of them are either external or technical. They're not an indication of the core business falling apart.
Okay, so let's start with a more procedural one, the one that sort of created that initial weakness in the stock's structure.
That would be the hangover from the reverse split. The company did a 1-for-10 reverse stock split, and that was effective on December 1st. Now, historically, this kind of move always creates a period of intense natural selling pressure. The report notes it's often just weak hands exiting the stock.
But I want to push back on that a little, because a reverse split isn't always just some benign procedural thing, right? Often it's a signal that management is worried about staying on the NASDAQ queue, about that $1 minimum. It can imply some real financial distress. Did the report address that counterargument?
It did, yeah, that's a great point.
Yeah.
And the report acknowledges that skepticism is valid. But it argues that in this specific case, the selling is just. It's exaggerated. It frames the reverse split as management trying to clean up the cap table, basically to prepare for a future capital raise from institutions, but only when U.S. regulatory clarity finally arrives.
I see.
So that immediate pressure is seen as short-term technical selling. It's just investors dumping the stock because they associate a reverse split with failures at other companies in the past.
Okay, so that handles the technical side of the selling. What about the political catalyst, the one that really didn't live up to the hype?
Yes. That was a classic sell the news event. It was all tied to President Trump's executive order on cannabis rescheduling. When the first whispers of that action broke, the stock jumped. It jumped aggressively in anticipation.
And the market was clearly betting on a huge leap forward. They wanted full federal legalization, like right then and there.
Precisely. And instead of that grand slam, the market got an incremental step. The proposal to shift cannabis from Schedule I down to Schedule III. And here's the key insight from the analysis that, most casual investors probably missed. Schedule III fails to solve the one true critical issue that institutional money was waiting for.
The 280E tax problem.
Exactly. The 280E rule, it prevents cannabis companies from deducting normal business expenses. It just cripples their profitability.
And a shift to Schedule III doesn't fix that.
It does not. So because the executive order didn't solve that underlying financial drag for U.S. operations, all that excitement just, it evaporated instantly. And that led to a massive, swift sell-off from investors who were looking for that immediate, huge profit.
So what's really important for you to understand when you're looking at this drop to $9.60 is that according to the source material, it wasn't driven by Tilray's core business breaking down. It was caused by impatient money, reacting to a technical mechanism and a political event that just didn't deliver the moonshot. And that panic is actually confirmed by a key technical signal.
Yes. If you connect that psychological selling to the hard data, the Daily Relative Strength Index, the RSI, it dipped below 30 during this drop.
Okay.
The report highlights that dip below 30, which is the technical definition of an oversold zone. Yeah. This confirms it wasn't some slow erosion of value, it was a quick oversold panic. And that, in turn, acts as a traditional buy signal for technical traders.
That distinction between technical selling and fundamental failure, that is just so key here. So if we accept that premise that the stock is being kind of artificially depressed, let's move on. Let's talk about what stabilizes the business right now, regardless of the regulatory chaos. The analysis report argues Tilray is fundamentally different from these pure-play cannabis stocks. So what's anchoring their revenue?
This brings us right to what the report calls catalyst number 2, the beverage safety net. See, Tilray figured out years ago that relying solely on the volatile and often disappointing cannabis regulatory cycle was just too risky. So their massive craft beer empire provides this foundational safety net.
Can you elaborate on that? I mean, how much of their revenue stream does that actually account for, and what specific brands are we talking about that help stabilize the balance sheet?
Well, the report notes that Tilray is now the 5th largest craft brewer in the United States.
Wow, 5th largest.
Yeah, this isn't some small side project. It's a significant operational enterprise. The specific brands cited are Sweetwater and Montauk. These are established names. They have stable revenue streams. So this non-cannabis segment provides consistent cash flow, and that helps offset the high costs of setting up all the cannabis infrastructure while they wait for federal reform.
So while their competitors are just purely speculative bets on future laws and are maybe just burning cash constantly,
Right.
Tilray has a functioning, reliable revenue floor that's built on beer sales.
Exactly. And this material stability, it just fundamentally distinguishes Tilray's risk profile. When you invest in a pure-play cannabis company, you are betting 100% on legislation. When you consider Tilray at $9.60, the analysis argues you're buying a significant U.S. craft brewer, one that's already operating at scale, that also just happens to own all the infrastructure and assets ready to capitalize on a future cannabis boom. That is a completely different risk calculation.
That stability is critical. Okay, so now let's pivot from that present-day safety net to the future potential. What are the specific time-bound upcoming catalysts that the analysis report points to that could, dramatically shift sentiment and maybe justify this 960 entry point for that 2026 outlook?
The report really hones in on two major near-term drivers that could provide the clarity the market is so desperately lacking right now.
Okay, let's start with the most immediate one.
The January 8th Q2 earnings report. This is less than 2 weeks away from the date of the analysis, and it's highlighted as the primary immediate catalyst. You have to remember, the market right now, it hates uncertainty. So a strong earnings report, or even just specific positive guidance, can rapidly reverse that technical selling pressure we just talked about.
And what key strategic development should we be looking for during that Q2 call? I mean, beyond just the typical profit and loss figures.
We need to be listening for substantial updates on their new Tilray Medical USA division. This was formally established mid-December, and this signals a really deep strategic shift away from that bearish narrative of Tilray as just another Canadian pot stock. By formally creating and funding this U.S. medical distribution infrastructure now, before full reform, they're showing some serious conviction.
That move from just exporting out of Canada to actively building U.S. infrastructure, that is a huge step, both symbolic and operational, looking towards 2026.
It is. It's a meaningful financial commitment. It shows the company is confident enough in eventual market access that they're willing to pay the high cost of building this out under the current difficult regulatory climate. It shifts the narrative from, hoping for U.S. access to actively preparing for it.
Let's talk about catalyst number 3, which really feels like the heart of the bull case at this price, the valuation reset. The report asserts that the stock is now trading at a deep discount. Can we quantify that for the listener?
This is crucial for anyone trying to evaluate the long-term value here. The report argues that at this current price, around $9.60, the market has completely wrung out all the speculative excitement. The froth is entirely gone.
So we're no longer paying for hype. What metric did the analysis use to show that we're now, buying the tangible assets at a discount?
The core metric is the price-to-sales multiple, or PS. The analysis notes that after this drop, Tilray's PS multiple is estimated to be around 0.8x.
0.8. And for context?
For context, the sector average for companies with similar growth potential is closer to 1.5x. So this significant undervaluation suggests the market is valuing the stock purely on its current stable revenue and just completely neglecting the future cannabis upside.
That makes the bull case very compelling. You're essentially buying the operating craft beer empire, the Canadian facilities, and the new U.S. medical infrastructure at 80 cents on the dollar, just waiting.
Precisely. The impatience of short-term sellers has created a quantifiable window of value for patient investors who are focused on that 2026 timescale.
Okay, let's shift gears. Let's look at the hard numbers in the analysis report. We need to know how Wall Street is viewing this stock, even after this big drop, and what the consensus upside projections look like from this 960 price point.
Well, the analyst consensus, it remains remarkably resilient, actually, despite the recent volatility. Wall Street is currently holding an average price target of around $16.
60.
That's the middle-of-the-road expectation, assuming the company executes on those catalysts we just discussed.
Wait, hold on. If the street is panicking and the stock is trading near its lows, why is Wall Street still holding a $16 target? Shouldn't they be slashing that?
Well, the report explains that the long-term analysts, they understand the difference between technical selling and fundamental potential. That $16 target, it reflects the expectation that clarity will return quickly on January 8th. And more importantly, it factors in that PS multiple returning to the sector average as the regulatory picture brightens heading towards 2026.
So let's do the math explicitly for anyone tracking this. What does that $16 target actually represent in terms of gains?
A move from the current $9.60 price to that consensus target of $16 represents a potential upside of approximately 66%.
A 66% gain.
That's the average projection based on what we know now and what's expected, even with all the recent negative price action.
And the analysis report also points out the blue sky high target. You know, the most optimistic scenario that always sticks in people's minds.
It does. Some of the more bullish analysts still maintain high targets of $25. Now, achieving that would represent a potential 2.5 times return on investment, a 2.5x bagger from this entry point. But that would require the U.S. regulatory doors to open significantly faster than expected.
So that technical insight about the RSI dipping below 30, you couple that with a $16 average price target, you get a pretty strong technical and fundamental argument for opportunity.
Absolutely. And finally, we need to stress the one immediate data point the listeners should be watching like a hawk. The source material is very clear on this, the $9.50 support level.
Okay.
The report advises that this is the absolute threshold. If the stock breaks significantly below $9.50, the immediate bullish thesis, which really relies on that January 8th catalyst to reverse sentiment, it could be invalidated.
So let's bring it all back together here. This deep dive has shown us the perspective from the analysis report. We've covered why the stock dropped, impatient money, post-split, insufficient political news, confirming a technical oversold event. We highlighted the business stabilizer, that reliable, massive craft beer empire, and we laid out the two big pieces of clarity coming soon: the January 8th earnings report and the commitment they're showing with the new Tilray Medical USA division.
The core conflict is still there. The market hates this short-term uncertainty, which is what drove the stock down to a highly favorable valuation, that PS of 0.8x. But the report really emphasizes that smart money looks for value and clarity, and that clarity is now just days away with the Q2 report. We've given you the full perspective on the bear trap, the quantifiable value, and the upcoming catalysts for that 2026 outlook.
This analysis provides such a unique insight into how these seemingly disparate business lines can stabilize an otherwise very volatile speculation.
What's fascinating here is how you see macro policy shifts, like cannabis rescheduling and these micro catalysts like earnings, intersecting with a completely unrelated but deeply stabilizing business line, like being the 5th largest craft brewer in the US. And this raises an important question for you, the listener. If the core business assets are anchored by a mature, non-volatile empire, does that fundamentally change how you evaluate the risk associated with betting on the uncertain yet potentially massive U.S. cannabis opportunity?